Sunil, I know you have been watching all of this, I'm sure, for hours on end, as all of us have. Where are we now in terms of what it means for the markets?
Yeah, good morning. Thanks for having me. I think, obviously, investors are understandably concerned about the geopolitical tensions here. What I would say is that you could see near-term pressure on the markets because of this, as we are already seeing here in the open here. But people would be well served in looking for the longer-term trends and sticking to that. However, I think in the near term, what's very clear is that this could put upside pressure on commodity prices or energy prices in general, as we are already saying. And that basically means that you could see firmer prices for energy and commodities in general. We are already overweight energy sector in our allocations because of the demand supply reasons. And so on the margin, we think this could sort of reinforce some of those views.
So when you look at central banks, and right now the Federal Reserve and others are drivers, right, for what happens across many asset classes, to what extent will you be looking for this situation in Ukraine versus Russia and the world response, and the fact that it could push up commodity prices, which stokes inflation and could be very bad for consumers, right, and businesses? That's a very important cost. How might that alter, even temporarily, the path of the central banks and your sense of what you need to do now? Stay in cash and just wait and see what happens, or put some money on the table?
Yeah, I think that's a great question. On inflation, I would say, at the macro level, the fact that if you sort of look at higher inflation, that usually puts pressure on equity markets in general. But I think the key point to note here is that at the same time, at least in Asia, you have China central banks, or PBOC, which is easing policy. And so in the macro context, wherein you have growth still above trend and PBOC easing policy, and even in markets where we're expecting rates to firm or central banks to tighten, they're not going to tighten as much as they are tightening in US. So in general, our view remains that markets on a full year basis should be able to do fine. We have a low to mid-teen target for Asian equities. But at a more micro level, you're right. I think inflation is an issue for companies, corporate profits and margins. And to that extent, we still sort of favor upstream areas over downstream areas in the markets. And in general, one of the favorite themes we have is the theme of pricing power. And so in general, we stick to companies which have a better pricing power, because we think they will be able to pass on higher prices to consumers and protect their margins.
We continue to monitor some of these lines from the speech that we hear from President Zelensky to his nation of Ukraine, saying that Russia is violating Ukrainian territorial integrity. He had earlier said within that speech that the decree really legalizes these troops in separatist areas, and that the effort undermines peace, as well as these ongoing diplomatic talks that have been held between allies, with Russia, with Moscow, to try and find a solution out of this crisis. And all of this coming as we really do see this kind of perceived escalation, and also the backlash when it comes to various sanctions from Western allies as well. So now let me take you to our question of the day, which sort of I think we alluded to a little bit earlier, but it really plainly asks, will these geopolitical tensions have an impact on rates? And what does it mean for rates? Because does this heighten the chance of a policy misstep? Could we potentially see, if central banks go ahead with tightening, that they're going to have to, rein back policy if we get that worst case scenario and the impact on global growth is worse than feared?
You're right. I think we think about this in the context of sort of global growth and rates, and to the extent if there is a tightening in financial conditions because the markets sell off, that could sort of that could basically mean that central banks may not go as sort of aggressive on tightening as perhaps before these geopolitical tensions came into picture. But I think I'll sort of point to the fact that when you sort of look across the region, especially for Asia, you still have parts of the region, especially China, which is still easing policy, and that has huge implications for how we think about markets in general. And then even for Asia in here, many of the central banks which we think will tighten, they're not going to tighten as much as in US. We're only baking in 3 to 4 rate hikes in most of the places because inflation in general is not a problem. in most of the parts. So I think our base case still remains that as long as the growth sort of comes through, especially in terms of corporate earnings, markets could grind higher. So in the near term, yes, there could be pressure, but I think investors will be well served in sort of looking through the near term volatility and focusing on the longer term trends here.
When it comes to China, there seems to be a cooling to do with the opportunities that a lot of investors have gone into, right? That underperformance coupled with more of a muted approach to easing, does that mean we need to be more selective when it comes to the Chinese market now as well?
I mean, on China, we actually have taken a more constructive view on China heading into 2022. We are overweight the market, both onshore markets and offshore markets. On the underperformance, obviously to be fair here, I mean, if you look at the markets year to date, China offshore market is basically flat, and S&P is down almost 7 percentage points. So actually, China is outperforming here, obviously, which is in stark contrast to last year, where S&P was up 27%, China was down 23%. But in general, I think that the main key point here for China, I would mention, is that when we speak to investors, and we have been talking to investors, a ton of investors over the last couple of weeks, people generally agree to a more constructive view on China, partly because of the fact that it's probably going to be the only major central bank which is still going to be easing policy. There is still a gap between sort of the mind share and the wallet share. And what I mean by that is even though people are generally sort of sympathetic to the idea that China may outperform here, they necessarily haven't put the money to work. And so from the allocation data, we still see a lot of people are significantly underweight China. And so we think as markets start to firm up, that could force some of the investors back in. So we think in general, I think China, our view remains that China should be able to have a better year and outperform the overall global markets.